Good morning, everybody. Thanks for joining me today. It's February 12th. Again, time just keeps flying ahead here. Before you know it, it's going to be March, and then April, May, and so on. But it does seem like maybe it's because we're having so much fun. Markets are doing extremely well. Try to correlate sometimes the market with the weather. We've had an unseasonably nice winter here in New York and Long Island, and most of that, though, was without sun. We had quite a bit of clouds and some rain, but no snow. But we may still get a nor'easter tomorrow, so we'll see how that plays out. And for all we know, there's something ahead of untoward for the stock market. But for now, it certainly looks like just one heck of a melt-up. It's been up dramatically since October 27th of last year. We had a brief correction from July 31st to October 27th last year. It was about 10% decline, but the market then just basically went straight up, led by technology. And I know there's still a lot of concern that it's a narrow market, but along the way, I've been trying to demonstrate that it's not quite that narrow. And I sent out a quick takes yesterday showing that while the S&P 500 information technology is up over 30% since the correction of last year, the S&P 400, the mid caps of the S&P are up, but technology is up 36%. So there's certainly been a lot of interesting developments in the stock market. I think continues to be a bull market. It's overdue for a little bit of a slowdown, a correction, sideways action for a while. But I guess people are just so excited by the notion that the Fed's not going to be raising interest rates anymore, that's turned out to be very bullish. Some of the technical indicators like the put-call ratio are such that they suggest there's too much bullishness. The bull-bear ratios suggest the same. But it's impressive how much the market has covered to the upside when money market mutual funds continue to increase. Money's still going into money market mutual funds, so that hasn't slowed down. What I want to do today is focus on, as we always do, on the morning briefing. And the morning briefing focuses on why economists have been so wrong. I've been asked along the way to kind of review what it is that most of the bears, the pessimists, missed over the past 2 years. So I'm going to spend a little bit of time doing that. Hopefully, I'll just kind of crank through it quickly because we've discussed many of these things before. By the way, Max is with us here. He's not been feeling himself too well. I know you can't see much of a difference because he's always lying down inert, taking a good snooze. But we hope he'll recover. He hasn't been eating the past day or two. So our hunch is that he ate something out in the backyard that he shouldn't have eaten. So we'll see how that goes. But let's go back to our program here and discuss the charts that are relevant to thinking about what it is that so many people missed about the economy over the past 2 years and about the stock market. One of the first persons to call a recession, I think it was in late 2021. It was a professor at Dartmouth, Danny Blanchflower, good guy, I know him. He apparently called the recession back in 2008 before too many other people did. He was on the Monetary Policy Committee at the Bank of England, and he commented on the outlook for the U.S. So he had a good call back then, and this time around he based his prediction of a recession on this chart here that we're looking at, which shows that this is it's a leading economic indicator. It's one of them. It's the average of consumer expectations. As you know, the consumer sentiment people and the consumer confidence people put out their surveys once a month. We've been taking an average of the two, calling it the Consumer Optimism Index. But one of the components in the LEI has also been this average of these two indexes. And so you can see in the LEI, the average of consumer expectations has started to roll over in late 2021, as you can see here. And that alerted the professor that maybe the consumers were starting to signal that they were going to retrench, and that could lead to a recession. This is the original source. The original source is exactly what I just said. It's the average of the Consumer Sentiment Index and the Consumer Confidence Index. And you can see that that also started to decline here. It's basically the same thing. I'm not quite sure why they don't line up exactly, but it's close enough. The consumer, as you know, went on to keep spending. There was some slowdown in consumer spending, particularly on goods in 2023, but they pivoted around to buying services. And so all in all, the consumer was a contributor to economic growth. So some slowdown actually in 2022 with everything, all the craziness that was going on there with Russia attacking Ukraine, oil prices soaring. But consumers actually came back quite strong in the second half of last year. Another indicator in the leading indicators, besides the one that we just talked about, is of course, well, I should say there's 10 leading indicators, and the one that the Dartmouth professor picked is just 1 out of 10. Why that should get more play than the others, I don't know. But when you take all of the leading economic indicators, including such things as initial unemployment claims, various orders for capital goods and consumer goods, building permits, so on and so forth. There's 10 of them, with one of them being the average of the consumer expectations. You can see that the red line, as we've discussed before, certainly has been predicting a recession. And it was, I think, in 2022, it actually peaked in December of 2021. And within about 5 months of 2022, the conference board, which puts together this index of leading economic indicators, said we're on the cusp of a recession based on this leading indicators. I've had some experience with this indicator, and I have to go back and look at some of the things we wrote back then. But I recall there was one episode where it was dead wrong, as it seems to be again now. And they took it back to the garage and retooled it, changed a couple of the components, and said, lo and behold, it back tests really well. And so I have a feeling they're going to be pulling this thing back into the garage and retooling it and coming up with one that back tests really well, and might have actually called the fact that there hasn't been a recession and may not be a recession anytime soon. But we'll see whether that's the case or not. But right now, this indicator is not working as much as it's touted out to be a leading economic indicators. What is working is the coincident economic indicator. That's 4 indicators, and that's been saying that we're still seeing the economy growing, and it's highly correlated with real GDP. It's a monthly series. It's at an all-time record high, and it's so far failed to do what it's done in the past, which has come down after the leading indicators anticipated a recession. So far, it's just not working. Another component of the leading indicators, as we've discussed before, is the interest rate spread. And you can see that it does have a tendency, it does have a good track record of inverting before recessions. And here it's done it again. I don't know why it particularly inverted here. I guess back there was a perception that Trump's trade wars might cause a recession. But in the current situation, the yield curve so far hasn't been correct in anticipating a recession. Now, of course, it's still inverted, so it's still calling for a recession. It could still be right. Something could happen to make a recession happen. But as we've discussed before, The reason that the yield curve inverts during periods of monetary tightening is the perception by bond investors that it's okay to buy a bond at 4% if the 2-year is 2%, because the 2-year isn't going to stay there very long. If the Fed continues to raise interest rates, something will break. There'll be a financial crisis. The financial crisis will lead to a credit crunch and then a recession. So far, the inverted yield curve has actually been dead on right. It called for a financial crisis, so we got one. We got one last March in the banking system. But what's different this time around is the Fed has so much experience with playing whack-a-mole. You know, that arcade game where you take the hammer and you knock down the mole when it pops up. Well, since 2008, the Fed's been very good at coming up with liquidity facilities overnight. And that's kind of what happened last year. The banking crisis was basically on a Friday, March 10th, and by Sunday, March 12th, they were announcing that they were providing a liquidity facility for the banks, and that calmed the situation down. So the financial crisis was correctly predicted by the inverted yield curve, but it didn't morph into a credit crunch, which then didn't turn into a recession. This is just another picture of the inverted yield curve. This is the 10-year minus the Fed funds rate, both what's in the LEI and the original source. This is the 2-year, the 10-year minus 2-year, which tends to be a more real, which is a much more real-time indicator than what's in the LEI. And that was starting to predict a recession back in the summer of 2022. And so far it's been wrong. But again, it's been right about calling a financial crisis. Some of the pessimists for a while, well, the perma bears, I'm accused of being a perma bull, and I view that as a compliment since the market tends to go up over time. But the perma bears have been showing a chart like this of the S&P 500 versus the Fed's assets, and their thought was surely as the Fed starts to do quantitative tightening, isn't that going to be negative for the market because it had been so positive for the market? And so far, the market isn't acting as though that's the case. The market's at a record high, even though the Fed is continuing to cut back on QT and hasn't really signaled just yet that they're even thinking about stopping that program of reducing the size of their balance sheet. Some very similar chart is the All Country World MSCI daily versus the combined balance sheet of the Fed, the ECB, and the BOJ. And again, you can always take two different series with upward trend lines, put them on the same chart, and they're going to look like they coincide. Coincidence isn't necessarily causality, of course, and much can always depend on how you scale these things. But this looks relatively, I mean, it makes sense, right? The major central banks are increasing their balance sheets, providing quantitative easing, keeping interest rates near zero. That's bullish for stocks. So when they go the other way, which is what we're seeing here, that should be bearish for stocks. And instead, stocks, it was bearish for a while, but stocks are back in the upside. That's because it's not that simple. If it was that simple, we'd all be making money all the time. It's very complicated, and in this situation, over in this period, the stock market went down because the central bankers were tightening because inflation was a problem, and now the central banks are all pausing and indicating that their next moves might be to lower interest rates because inflation is coming down, without necessarily acknowledging that they're going to stop their quantitative tightening. I mean, at some point, they're going to say that that's enough, and maybe we'll get another hip hip hurrah, hooray rally on that. As we've had this rally, I think here is basically a rally based on the fact that investors came to the conclusion that the Fed's done raising rates, and then the big debate turned out to be, well, how many rate cuts and when are they going to occur? We've been arguing that there wouldn't be as many as the market thought, and the market is having second thoughts about 5, 6, 7 rate cuts. We're still in the 2 to 3 rate cuts. So here's the Fed funds rate. Here's another reason that I mean, this is a very logical reason for being bearish. The Fed raised interest rates by 525 basis points during the current tightening. We've had previous tightenings, even this one that had not, with the pandemic recession had nothing to do with rates going up. But even here, there was a tightening. There's a tightening move before this recession, then a pause, then the recession hits. Same thing here, same thing there here. So tightening monetary policy tends to cause recessions. Why didn't it do it so this time around? Well, part of my story is that you have to look at the picture here. The picture is we were at abnormally low interest rates. Now we're kind of back to normal interest rates. This is kind of where they should be. I don't really need to have the Fed lower interest rates as long as the economy continues to perform well and shows that it can handle these rates, it's resilient at these rates, and that these rates are sort of normal. Maybe the economy would have done just fine if they hadn't jerry-rigged the bond market and interest rates back here. But so it's not just tightening here; it's also normalizing. I think we can live with these kind of rates. I think with the bond market at 4% is something that the economy can continue to function. That raises some questions of, well, why is that? Well, the rolling recession is something we've discussed before. I won't bore you with that again, except briefly. We did have a recession in housing, in total housing starts from the tightening of monetary policy. But as you can see, it was very much in single family. Multifamily was still very strong. So we had a rolling recession hitting single family, while multifamily was strong. Now we're having perhaps a recession roll into multifamily because of overbuilding. Rents are starting to weaken, have been weakening. But meanwhile, single family is doing better because rates have stopped going up. They've come down a bit, and there's a lot of pent-up demand for housing. Then, of course, the big surprise to the pessimists has been the consumer. People like Jamie Dimon were promoting the idea that the consumers had excess savings during the pandemic, that they were spending those excess savings. They'd run out of their excess savings surely by Dimon was making this argument back in this spring of 2022 and said a hurricane was coming. But what happened instead is, well, we didn't have a consumer-led recession is what happened. You can see that this is, I think, a fascinating chart. This is inflation-adjusted consumption, services, and goods. Look at this. We didn't really have a recession in goods. I've been talking about a rolling recession in goods, but it's really been a growth recession. It's not like, I mean, we just had goods, a buying binge for goods by consumers that took it to an all-time record high. This was the trend. We got way off that trend on the downside, and then we went on a buying binge here. And then it kind of stalled out, but it just stalled out at basically a record high. It's not as though we kind of went kind of down again. So the consumer, in terms of goods, actually remained pretty robust in their spending on goods. And now we're actually at a record high on inflation-adjusted consumption of goods. Now, take a look at services, and services has been just, it was a laggard relative to goods because of social distancing restrictions. And then they got lifted. And so people pivoted away from increasing their spending on goods. Again, that's a very interesting phenomenon here. And instead of increasing their spending on goods, they just kind of went sideways at a record high. And meanwhile, services started to do better, and they're at a record high. So what is it that keeps the consumer spending? Well, I've often observed in the past that Americans are wonderful people. When we're happy, we spend money. When we're depressed, we spend even more money if we can get it. If we're losing jobs, obviously, we're not going to do that. But between the excess savings that accumulated the pandemic that were spent when people still weren't working, we've now seen the unemployment rate below 4% for almost a year and a half. So unemployment's been persistently low. There are plenty of jobs out there. So now that consumers maybe are running out of excess saving, there's plenty of jobs out there, and wages are rising relative to prices. Real wages are increasing. And then I've been tossing around this idea for a while that as a baby boomer, a lot of my friends are retiring. I'm not. I still got 5 kids, and a couple of them are still at home. So I'm still working for a living. Besides, I enjoy it. I don't play golf, so I intend to do this until they take me out in a box. But well, let's not go there. But the consumers, my friends, the baby boomers, they're retiring, and many of them had not 5 kids, but one or two, maybe 3 kids. They're all adults now. They're self-sufficient, and the my friends, the baby boomers, are going out to restaurants a lot more. They're traveling a lot more. They're going on cruises, and they're seeing their healthcare providers on a regular basis. One of my cousins just told me that he's getting knee surgery, because he spent so many years playing racquetball. Now it's coming back to get him. But he just told me that they're keeping their house here in Long Island, and they bought a property in Florida. But there's a lot of people with these kind of examples, and they're just doing different things in terms of consumption. And as I've said before, 40% of people who own their homes don't have a mortgage. So a lot of them, I'm sure, are the baby boomers. And the baby boomers have always had a big impact on the economy, and they're doing it again. And they're spending, and they're supporting some of their younger children. I know this from personal experience. Um, and they have $75 trillion of basically retirement assets that they've accumulated. The richest cohort ever. Never been a generation this wealthy. And that's certainly something that has to be factored in to why consumers are doing quite well. The pessimists, the recession forecasters, also kind of obsessed about monetary policy and forgot to really focus also on fiscal policy. In the past, we've always had stimulative fiscal policy after it wasn't needed anymore. We'd fall into recession. The Fed would lower interest rates. Congress would take a while to come up with tax cuts or spending increases. And by the time that happened, the Fed had already lowered interest rates. The economy was already recovering. This time around in 2022, we had some massive fiscal spending programs that had nothing at all to do with anticipating a recession. And yet they were extremely stimulative and kept us out of a recession, or one of the factors that kept us out. And so there was a lot of spending on private non-residential, all-time record high, a lot of spending on public infrastructure spending, all-time record high, and even residential, which had a recession here, has started to recover. So construction employment, all-time record high. This just doesn't happen during recessions. During recessions, you lose jobs in construction. Another factor on the fiscal side, defense spending, all-time record high. Kind of makes sense given how crazy the world is. The U.S. Needs to scramble to provide more arms to Israel, to Taiwan, to Ukraine, and so as a result, we're seeing defense spending at an all-time record high. And then this is net interest paid by the government. Now, why could that possibly be a good thing? Well, I'm not in favor of it. I would prefer that we didn't have as much debt, and that the government debt wasn't the fast interest payments wasn't the fastest category of outlays by the government now. But it is net interest to those who are clipping the coupons, getting the money market interest on the treasuries. And so that's actually another source of stimulus. This is personal interest income. And as you can see, it's at an all-time record high. So I'm thinking that maybe the personal savings rate isn't going up as the pessimists have been thinking. They're saying, look, this is all excess savings being spent. So the savings rate has taken a dive here, well below what it was before the pandemic. And now it's down here because of the excess savings. They spend the excess saving, and then they realize, oh my goodness, we've spent our excess savings. We really have to increase our savings rate again. I don't get the logic of why that would be the case, but that was the argument. That's been the argument. That consumers say, oops, we ran out of excess saving. Let's go back and save more, which means that they retrench. They spend less of what they have as income. But I think the savings rate's going to stay around 4% for a while. The baby boomers, as they retire, say, well, what was the point of doing all that savings in the past? We don't need to save more. We need to just kind of figure out how we're going to spend the money that we have now. How much do we spend on having a great time? How much do we have set aside just in case we need some extra health care that we have to pay for out of pocket? And how much do we want to leave the kids? So I think the unemployment, the savings rate remains around 4% for as far as, well, for the rest of the decade, just to be exact. And another reason for that is the young kids, the young adults, they got to be anticipating that there'll be some inheritance. So they may be saving less as a result of that. So this is just another picture of consumers. This is real wages and salaries. This is real unearned income, which is basically interest. It's interest, dividends, rent, and proprietor's income. And it's a big category. Interest income, all-time record high. Dividends, all-time record high. Rent, all-time record high. Proprietor's income, all-time record high. So that's another source of spending for the consumers. So this is the baby boomers again. They're since they started to I think the oldest of them first turned 65. Let's say that's the retirement age. People obviously are working past that. I'm working past it. But since the first one started to retire, we've had 20 million more seniors in the economy. That's this number, population. And you can see a lot of them have been retiring. They're not in the labor force. A lot of them stayed in the labor force. And now maybe they're starting to, these are the ones that are in the labor force. And now you can see that maybe they're starting to retire. So productivity is another variable that's been sort of ignored by the pessimists, by the naysayers, and productivity is much to my surprise. I've been an optimist in productivity, but I'm very pleased that it's already showing signs of making the comeback that I've been expecting, and so it was up 2.7%. So maybe real GDP isn't kind of stuck at this slow growth path of 1.5 to 2%. The Fed's projection is that the underlying long-term growth rate of real GDP is 1.8%. I'm thinking it could be 2.5, 3, 4%, depending on just how great the productivity boom is. So here's, I don't know why it's stuck back here. I know there was a logic to it, but it's the yield curve spread again. And here's that mini banking crisis. Credit crises in the past were triggered by some sort of financial crisis. Then the credit crunches caused a recession. This time around, we've had the banking crisis, but we haven't had the credit crunch. We haven't had the recession. So that's all she wrote, as they say in the TV show. Let's go have a quick look here at see which glasses I got here. Good. Let me take a little with the whistle here. Okay. Okay, Cactus. Hi, Ed. What would be your probabilities between these three macro scenarios at this point? One, a hard landing. Two, soft landing. Three, no landing. Being growth is strong enough to floor inflation. Oh, okay. Yeah, I mean, I've been saying 60% likelihood of a roaring 2020 scenario. So I guess that's no landing. Productivity makes a comeback, inflation comes down, economy doesn't have to fall into a recession in order to bring inflation down. And then a 20% chance of a 1970s scenario, inflation makes a comeback, Middle East situation gets even more horrible, price of oil surges, causes another wage price spiral. The Fed can't lower rates, might actually have to raise interest rates again. And that would be an inflationary hard landing scenario. And then 20% for the 1990s scenario, where it's too much of a good thing. Stock market, we have a speculative bubble in the stock market. Everybody buys NVIDIA, and the mega cap 8 just keep going up. And then something leads to that unraveling. Maybe the market starts to realize that AI is not quite ready for prime time, and maybe it can decipher scrolls from prehistoric times, but the limits of it are still such that it can only be used in applications where there isn't a lot of downside risk if it happens to make a mistake. So that's kind of where I'm at. You laid it out slightly differently. A hard landing. It also depends on the time frame, right? So if we're talking about this year, hard landing is low probability, in my opinion. Didn't really mention it much in the scenario I just laid out, other than maybe, I guess you could say that a hard landing is a 40% chance if we get a melt up in the stock market that sets us up for a meltdown, and that would be 20%, and then 20% if a further calamity in the Middle East leads to the price of oil going straight up, and then that leading to a hard landing. Ian, your take on whether high interest rates are keeping rents elevated as more buyers are kept out of the market to buy, and once rates decline more, supply will arrive in the market. There's a lot of moving parts there for sure, and yeah, I think to the extent that people have to rent because they can't afford mortgage rates at this level, then presumably that's would be keeping rents up. But look, we've all been watching these real-time indicators on rents from Zillow and Apartment List, and they actually showing rent inflation coming down substantially. I know there's been some fine-tuning of that, saying that rents are actually coming down in large urban areas, but in some of the smaller cities, rents are going up because that's where people are moving to. So there's a lot of, like I said, a lot of moving parts there. But I'll go with Zillow and Apartment List and conclude that rent inflation has come down a lot, and that with a lag, it's going to be reflected in the CPI. So we'll see what it looks like. I guess tomorrow we get the CPI. Okay, I'll take a couple more here. Vincenzo, you have just told us that retiring baby boomers are spending a lot. In your own firsthand experience, do you see any sectors that can benefit in the stock market? Well, yeah, I mean, it's clearly there's my friends, and we are too, spending more on restaurants. So restaurants should continue to do quite well. We're spending more on taking more trips abroad and seeing the parks and all that. And so the hotels and cruise lines. I mean, a lot of these things have already been anticipated. The hotels and cruise lines, but maybe it's not over. I mean, I'm hearing people that never went on cruises, friends of mine that now have gone from they enjoyed the first cruise so much, they're taking another one 6 months later, and they're finding that they're booking it way ahead. My wife and I want to go to Italy. We are going to Italy in September, and she's frustrated because so many things that she wanted to do are already getting booked. So that's an indication that people are still traveling. So the airlines, I guess, would be something to think about. And of course, healthcare is a big winner from aging baby boomers who want to make sure that they're in good health so that they can spend all their money before they have to leave it all to the kids. Gus, I'll take this one last from Gus. Can you speak to the fact that it looks like Europe and Asian economies are all looking at reducing rates? Does that limit the deflation being exported in goods? Good question, but I think a lot of the deflation is made in China, and a lot of that has nothing to do really with interest rates or how much stimulus the Chinese are going to provide. They've got a property bubble that's burst, and the experience from Japan and the United States demonstrates that it takes 5 to 7 years for a property bubble to kind of get all the air out of it and to stop being deflationary. And on top of all that, China's number of births, 9 million babies were born last year. But that's actually the lowest on record going back to the 1950s. And China's population is actually shrinking. So I think deflation is, to a large extent, made in China. Disinflation was made in China when Walmart bought all these cheap tchotchkes and other goods from China way back a couple of decades ago. Now, during the current environment, they're exporting deflation, and that's actually benefiting us. We don't have to have a recession to bring inflation down. So with that happy thought, let me thank you for joining me as always. And let's. I think next week is president, so we'll probably do it on Tuesday. Thank you. All the best.